RSP holds the same constituents as the S&P 500, but it expresses that market in a fundamentally different way. A single structural change, equal weighting, redistributes risk, returns, and leadership across the index. Over long holding periods, that structural difference can become a major driver of relative outcomes. RSP is the ticker for the Invesco S&P 500 Equal Weight ETF. It holds the same constituents as the S&P 500 and follows the same index inclusion and maintenance rules. There's no difference in company selection or market coverage. RSP assigns equal weight to each constituent rather than weighting companies by market capitalization. This changes how exposure is distributed within the index without changing the index itself. In market capitalization weighted S&P 500 funds, a small number of large companies can represent a significant share of total assets. As a result, overall index performance becomes highly sensitive to the outcomes of those few holdings. RSP materially reduces single stock concentration. Influence is distributed evenly across all constituents. Exposure shifts away from the largest companies towards the average constituent. Risk is spread more evenly across the portfolio rather than concentrated at the top. RSP tracks the same equity market as the traditional S&P 500 ETFs, but it produces different return experiences. Underperformance tends to occur when market leadership is narrow. A small group of large companies drive most index gains, and capital remains concentrated in those dominant names. In these environments, market cap weighted indices benefit disproportionately. Outperformance tends to occur when leadership broadens. Returns become more evenly distributed across the index, often without clear or widely recognized signals. These periods attract less attention because gains are not driven by a small set of identifiable winners. Equal weighting assigns the same target weight to every stock in the index. Allocation is determined by count, not by company size. With roughly 500 constituents, each position is set near to 0.2% of the portfolio at each rebalance. No stock starts larger than the other. Company size doesn't influence allocation. A multi-trillion-dollar company receives the same weight as the smallest constituent in the S&P 500. This produces a flatter distribution of capital. Influence is spread across all holdings rather than concentrated at the top. It also produces a flatter distribution of risk. No single stock or small group of stocks dominates day-to-day movement. Equal weighting changes how returns are generated and how risk is experienced over time. Between rebalances, stock prices move independently. Returns accumulate at different rates across constituents. Stocks that outperform drift above their target weight. Their influence on portfolio returns increases automatically. Stocks that underperform drift below their target weight. Their contribution to returns declines. At each scheduled rebalance, allocations are reset. Positions above target are reduced. Capital is trimmed from stocks that have gained relative weight. Positions below target are increased. Capital is added to stocks that have lost relative weight. It applies one rule consistently: restore equal weights at each rebalance. RSP's behavior depends on how market leadership evolves. Its relative performance is driven by how returns are distributed across constituents. When leadership rotates, relative performance across stocks changes. Capital shifts between sectors and industries. Market participation broadens. Concentration declines. In these environments, equal weighting tends to benefit. RSP captures returns from a wider set of constituents, rather than a small group of leaders. When leadership is stable and concentrated, outcomes differ. The same companies continue to dominate returns. Capital remains focused on a narrow set of large stocks. In these conditions, equal weighting tends to lag. Capital is systematically reduced from dominant leaders. RSP exhibits persistent factor tilts over long horizons. Equal weighting increases exposure to smaller companies within the S&P 500. These companies remain large cap by index definition, but they exhibit different return, volatility, and sensitivity characteristics than the largest constituents. Equal weighting also increases exposure to lower relative valuations. Stocks that have appreciated less receive proportionally more capital at rebalance. This introduces valuation sensitivity without explicit valuation screening. Rebalancing systematically reduces exposure to recent outperformers and increases exposure to relative underperformers. If relative performance reverses, the structure benefits. If it doesn't, the effect is neutral or negative. At the same time, equal weighting reduces exposure to mega-cap growth dominance. No single company can accumulate outsized influence. Persistent momentum is trimmed rather than reinforced. These factor tilts arise directly from the weighting methodology itself. They emerge over full market cycles, they're not dependent over short horizons, and short-term performance can diverge materially. RSP has often exhibited higher volatility than market cap weighted S&P 500 ETFs over full market cycles. Volatility increases because capital is distributed more evenly across constituents. Smaller companies within the S&P 500 receive greater relative weight, and their price movements contribute more directly to portfolio returns. Equal weighting also increases sensitivity to dispersion. When returns differ widely across stocks, those differences are transmitted more fully into index level performance. In an equal weight structure, more stocks influence daily movement, and fewer outcomes are muted by dominance from the largest companies. Risk is expressed across a broader set of constituents, rather than concentrated at the top of the index. Understanding this distinction helps prevent misinterpretation of short-term fluctuations and aligns expectations with the fund's structure. RSP exhibits higher portfolio turnover due to its quarterly rebalancing process. Maintaining equal weights requires regular trading. At each rebalance, positions that have grown beyond their target weight are reduced, and positions that have fallen below target are increased. This process generates transaction activity that doesn't exist to the same extent in market cap weighted indices. As a result, operating costs are structurally higher. Portfolio turnover is persistently greater than in traditional S&P 500 ETFs, and this translates into a higher expense ratio. The cost difference is predictable and mechanical. Costs are incurred solely to maintain equal weight exposure. Expense should therefore be evaluated relative to structural intent. RSP is most commonly used as a partial alternative to market cap weighted S&P 500 exposure. It's typically introduced alongside traditional index holdings to reduce concentration risk. When combined with market cap weighted exposure, it alters how risk is distributed across constituents. The influence of the largest companies is moderated at the portfolio level. RSP is generally implemented as a long-term structural holding. It's rarely used as a trading instrument. Short-term relative performance is unpredictable, and it's not a design objective. Over brief horizons, transaction costs and tracking differences reduce effectiveness. RSP does not diversify across asset classes. It alters diversification only within the US large cap equities. The impact of this structure increases with time, as compounding reflects weighting differences. RSP is not an active fund. There's no analyst judgment, forecasting, or security selection. All holdings are determined by S&P 500 index membership. Inclusions and removals follow the same published rules as traditional S&P 500 ETFs. RSP is also not a small cap strategy. Every constituent meets the S&P 500's large cap eligibility requirements. Differences in behavior arise from weighting, not from market capitalization drift. The fund does not engage in factor timing. Any factor characteristics are structural. Size, valuation, and mean reversion effects emerge mechanically from equal weighting and periodic rebalancing. Understanding what RSP is and what it's not ensures the fund is assessed on structure rather than intent. RSP tends to perform best when market returns are broadly distributed. This includes environments where leadership rotates, participation widens, and concentration declines. RSP tends to lag when market leadership is narrow. When a small group of stocks dominates returns and momentum persists, equal weighting becomes less favourable. These outcomes are not anomalies. They are the direct and expected result of the weighting methodology. RSP holds the same constituents as the S&P 500. The difference is how exposure is expressed. Equal weighting reduces concentration and increases breadth. Over long horizons, index structure often influences outcomes more than security selection. RSP doesn't seek to outperform the market through security selection or timing. It applies an alternative weighting framework to the same market. When that distinction is understood, performance is evaluated as a function of structure, not as a signal to react or adjust.